Hello, good morning and happy Friday to all. Welcome to today's Daily Dose of Market Insights. Good morning and happy Friday. I'm Kelvin here again. Today will be Friday, the 6th of September 2024. So before we jump straight into today's gist of Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook on the major cross asset classes, firstly, let us recap what has taken shape yesterday in terms of the news flow, respective data release, and its impact on the intraday performance of the various key major cross asset classes. Secondly, I will share with you a more of a medium-term fundamental and intermarket dynamics that is playing out right now in one particular area of the cross asset. And also to sum up the week, I will share with you what are the key economic data and events to look out for today. So let's start with yesterday. So yesterday we do see a rather lackluster performance in the major US stock indices again yesterday for the second consecutive day. So rather lackluster. What we could see over here is majority of the major US indices closed in the red. The SPX down negative 0.3%. The Nasdaq 100 managed to close almost unchanged, supported by a few key mega cap technology stocks that are managed to help the fort. But the Dow Jones and the Russell 2000 kind of underperformed yesterday, down negative 0.54% and down negative 0.61% due to this particular news flow, which is pertaining to a second tier job data release, the ADP job data release. So this particular ADP job data release was yesterday. So we know that US, there are actually a slew of job data. So the top tier will be this Friday, later the NFP payroll data that's been compiled by the government agency. So yesterday we do have a release of ADP. So ADP is a private organization that compile monthly job opening data in the US economy. So yesterday, this particular ADP data over here on the share view, where is it? Okay, over here. Okay, my apologies, because just now I scrolled down too fast. Okay, where is this data release? Yeah, this is the one. All right, ADP. Okay, if you look at my screen over here, okay, let me put it in. I think this should be quite big enough. Yeah, all right. Okay, ADP employment change. Okay, so basically what's the difference between ADP and today's non-farm payroll is the organization that is being tasked to compile this particular job data. So ADP is just a private organization that's been tasked to compile this monthly employment change data in the US economy. It shows the job market continues to actually sluggish in a very lackluster state of affair. And in August, it actually went down a fair bit of only 99K job added, way below what market is expecting of 145K. And the previous month of July was being slightly revised downwards. Previous data is showing 122K job added for July, but the latest modification, there was a downward revision to 111K job added. And if you look at the trend of the ADP employment change data as being compiled by this private organization, it's sluggish in a downward trajectory since April 2024. And yesterday, raw number of 99K job added is the lowest. We go to the 5-year, right? Okay, 99K. Okay, it's the lowest since February 2021. Okay, if you look at the trend over here. So overall, it tells us that the labor market, based on this second tier job data as compiled by ADP, is in a state of sluggishness. That means, i.e., it increases the odds of a recessionary scenario in US, which means that the narrative of the Fed being late in the game starts to play out back in the market again. So that actually causes the cyclical stocks, which is heavily weighted in the Dow Jones Industrial Average and in some form of the Russell 2000, to actually underperform the market yesterday. So if you look at the heat map of the S&P 500, okay, over here, okay, very quickly, almost all of the sectors are in the red, and the S&P yesterday was being held up surprisingly by consumer cyclical or consumer discretionary sector, which Amazon is one of the mega cap technology stocks that gained 2.6%, and some form Nvidia managed to actually inch up higher after 2 consecutive days of disastrous losses. Now positive yesterday, intraday positive 0.9%. So if you look at the sectorial heat map, means on the S&P 500 broken down by 11 sectors. So what we could see over here is that all the nine sectors all closed in the red. The only one that managed to survive in the green was the consumer discretionary, held up by Amazon, which is one of the mega cap stocks, and communication services up 0.47%. All right. So net overall, I would say that yesterday's session was a rather lackluster US stock market session due to recessionary fears that the Fed is late in the game, and because of recessionary fears, the Fed being late in the game, there are actually much more bets now being placed in the upcoming September meeting, which is pretty much due in 2 weeks' time, that the Fed may enact a much more wider interest rate cut or deeper interest rate cut of 50 basis point over 25 basis point. And how do we know that? By looking at the pricing data as being compiled by the CME Fed Watch 2, that taken from the Fed Fund futures pricing, where we are able to see the percentage odds of how many bets are being anticipated on whether a 25 basis point cut could take shape or a 50 basis point could take shape. And these particular odds are actually dynamic in nature, they're not static over here. So what you could see over here is that it's almost like on par over here right now. Okay, if you look at the target rate probabilities for 18th of September FOMC meeting. So the current rate is 5.25% to 5.5%. So still around 59%. Majority of them are skewing towards at least a 25 basis point cut to bring it down to 5% to 5.25%. But the odds has started to increase in the last few weeks over here. Previously, 1 week ago was 34%. Over here, now it increased to 41%, calling for a 50 basis point cut as being implied by the Fed Funds futures market. So to bring down the Fed Funds rate to 4.75% to 5%. And that actually translate to further dollar weakness almost in almost in majority of the major pair when quoted against the dollar, the major FX currency when quoted against the dollar. And how do we see that? By looking at this 5-day rolling performance of the dollar against the other major currency as of now, intraday as we are speaking. So what you could see over here is that the $1 is underperforming against the safe haven currency like the dollar yen and the dollar Swiss franc over here, trading way below the dollar index, okay, DXY. And the one that is holding a relatively steady but is in a slowly declining rate as well will be against the Aussie, the Kiwi, the CAD, and more or less somehow or another against the Chinese yuan. But then overall, it seems to us that we are now seeing a kind of a dollar weakness across the board, except that the momentum of the dollar weakness is being seen much more significant against the safe haven currency like the Swiss franc and the dollar yen, the yen itself. All right. And one particular news flow over here is coming out from the oil market, which is OPEC. And we know that oil price this week managed to shape a bearish breakdown below a key major range support level. For those who are unsure what I'm talking about, not to worry, later I'll flash you the technical chart of the WTI crude oil when we touch on the intraday technical segment thereafter. because of this breakage of below this $73 and $72 per barrel on West Texas crude oil, the oil prices tumbled significantly this week, and that causes the oil prices to be to sluggish and give up all of today's year-to-date gain. All right, and that actually kind of pressed the panic button in the cartel, OPEC Plus. So OPEC Plus yesterday issued a statement, official statement, it's not rumored, that they desire to pause oil supply hike next month. All right, so what they intend to do is that they plan to propose their oil supply hike by 2 months. All right, by 2 months over here. So not say permanently removed, but just pause. And that actually causes the oil price to rally. So for those who actually follow our daily dose of market insight, yesterday we do see some form of short-term bullish divergence in oil price in WTI crude, where we flip to a intraday bullish bias for that mean reversion rebound, and that mean reversion rebound exactly hit that resistance level. And despite this particular positive news flow up for OPEC Plus, it can't surpass back above the $72 per barrel. Right, that actually represents some form of negative momentum that is still inherent in the oil market. So later I'll touch more about that when we cover the short-term intraday technical outlook on West Texas crude oil. All right, so that actually sum up the key news flow and its impact on the various respective cross asset classes. All right, so now with that, now let me touch with you one fundamental and intermarket dynamics pertaining to the FX market for today that I'll share with you. And this actually comes with the yen crosses. Because we know that just now I shared with you earlier on, the Japanese yen is strengthening against the dollar. Then if I were to take into a closer inspection against the yen, that means i.e. the yen against the other currency. All right, that means talk about the yen crosses. That means talk about Aussie yen, Norwegian yen, sterling yen, SEK yen, CAD yen, Euro yen, Swiss yen, and the dollar yen. So these are actually G10 yen crosses. Yen itself is the variable currency. So what we could see over here is that since the start of September, so this is the 1 month rolling performance. That means it moves every day, but a look back period of 1 month. So since the start of this month, September, the yen crosses has been falling significantly. All right, also being dampened, being supported by the yield premium between the US 2-year Treasury yield premium is getting lesser against the 2-year JGB yield. That means the yield premium over 2-year Treasury yield over the 2-year Treasury note against the 2-year JGB, the yield positive premium starts to shrink significantly as well. All right, and this is also ongoing, being affected by the two-way movement, where the 2-year JGB yield starts to increase significantly, whereas the 2-year Treasury note starts to decline. So that is actually a clear divergence of monetary policy. And don't forget, 2 days ago, Bank of Japan Governor Yuda stressed that as long as Japanese economy continues to remain in their trajectory in terms of growth and in terms of inflationary trend that is ticking gently upwards, there is no reason for Bank of Japan to reverse back to its quantitative easing policy and cutting rates back to negative territory, and they will gently slowly normalize their interest rate policy. That means ongoing forward, that could be still one more potential interest rate hike in Japan by BOJ before 2024 ends. So this is the divergence of monetary policy that lead to the yen crosses to actually plummet since the start of this month. That means, i.e., what we could see over here is that there could be another significant leg of yen crosses plunging, i.e., yen strengthening. And how do I see that? The next chart I want to share with you is plotting a basket of, I don't think I shared this before, in the daily dose of market insight so far, is what I did over here is that I plot a equal weighted basket of yen crosses on the G10 currency. That means using Aussie yen, Kiwi yen, CAD yen, SEK yen, Norwegian yen, Euro yen, sterling yen, Swiss yen, and dollar yen as a basket of yen crosses. All of them equal weighted. I can come up with like an index chart, all right, a yen basket index chart, and I plot it and I do some technical analysis on it. So you realize that this strong push up, this is a monthly chart, so it's a very long term trend chart over here. So what you could see over here is that from 1st of June, it shaped a significant push up, all right, and this significant push up was damaged on in July itself, right? In July itself, way before the sell-off in August, early August, and it reintegrate back below this major ascending channel. And what we could see over here is that this box over here is considered as a major failure bullish breakout because price could not sustain above the 2007 high. 2007 high, mind you, that is more than a 15 years ago high or 14 years ago high. So this high was actually being met before the great financial crisis, where we start to see risk assets class sold off due to the subprime crisis in US over here. So there was a failure bullish breakout at that point in time. And what we share with you all is that before the failure bullish breakout at that point in time in June to July, the monthly RSI hit over here. You could zoom my screen. The monthly RSI in June, recorded in June, hit a high of 78.01, and this high is just inches below its current most extreme all-time high in 81.25. That synchronized with the peak, the former major peak in July over here in June, July 2007. Right, let me show you. Okay, in June 2007 to be precise. All right, so over here, this price reintegration back below 11.80 level, and what we could see over here is that at the start of this month there was a retest to it, and right now it's shaping this very bearish reaction candle. But for sure this candle hasn't ended yet because this is a monthly candle, but it's very clearly moving on the downside. And what we could see over here is that the RSI after hitting a very close significant resistance level, overbought resistance level at this 78.01, very close to the extreme overbought level that in historically made so far at 81.25, it staged a bearish breakdown below a former parallel ascending trendline support, indicating that downside momentum has started to rear its heads in the yen basket index that I created. All right, and this phenomenon or this negative observation took shape in the past in this dotted line here, which is in August 2007, that preceded previous significant decline in the yen basket index. All right, so there is a pre-bearish condition, all right, at that point in time, and this pre-bearish condition similarly has been met right now. So potentially, based on this past observation of this yen basket index, it could mean that the yen crosses could still see significant downside movement from a multi-week perspective, with the next support coming in at 103.90 next, because this is a monthly chart. So something to take note of. We may start to see another bout of significant yen crosses downside movement. That means i.e. yen strengthening. All right, so this is the key technical, key fundamental and intermarket dynamics element or observation on the FX market for today that I'll share with you all in today's daily dose of market insights. All right, great. So with that, now let us now shift our attention to the intraday technical outlook on the various broad-based cross asset classes that we tend to cover in our daily dose on a frequent basis, starting with the FX market. But with that, let me expand my screen so that you guys can actually focus much clearer on the key technical levels that I'll be sharing with you all. All right, so now with that, let us start with the FX market first, starting with euro dollar. So the euro dollar continues to push up and hit the first resistance level that we highlighted yesterday, 110.05, and it continues to show signs of bullish momentum still intact as the hourly RSI continues to print a series of higher low. All right, so with that, we will have a slightly tightened key short-term pivotal support level for today. Tighten it from yesterday from 10.1026 to 10.1060, very close to the rising 20-day moving average as well. So as long as today's 110.60 short-term pivotal support holds in any potential pullback, we will still maintain our short-term intraday bullish bias on the euro dollar. Next resistance level to watch for today on the intraday basis will be 111.40, followed by last Monday, not Friday, last Monday, minor swing high area of 26th of August at 112 figure level next. All right, so that's for the two intraday level to watch out for on the euro dollar. Only an hourly close with a breakdown below 110.60 will invalidate today's intraday bullish bias on the euro dollar to kickstart another leg of minor corrective decline to retest this week low at 110.26. A breakdown below it exposes 110 figure level and potentially may even seize 109.50, which is correspond to the rising 50-day moving average as well. Okay, at 110, 109.50. Moving on will be the sterling dollar. So the sterling dollar also going to inch up, but hasn't cleared above our first resistance level yet, which we highlighted yesterday, 131.90. So momentum still remains pretty much positive on the hourly RSI, going to depict a series of higher low. So with that, we will still maintain our short-term intraday bullish bias because it hasn't cleared above our first resistance level. We will still maintain our first pivotal support level that we highlighted at 30.80, no tightening above to 131.19. So this 131.19 could be used as a first support, but because the price action hasn't broken above 131.90, we will be still more conservative to maintain yesterday's pivotal support at 130.80. So still no change, still remains bullish bias as long as 130.80 short-term pivotal support holds. A breakup above 131.90 exposes the next near-term resistance, which was last Wednesday minus swing high of 28th of August at 132.65 next. Only an hourly close below 130.80, a breakdown below it invalidates today's bullish bias to kickstart another minor decline scenario leg to expose the next near-term support level at 130.40/130.10. A breakdown below it sees 129.40 further out, which also corresponds to the rising 50-day moving average as well. So that's for the sterling dollar. Moving on, next will be our attention on the Asia Pacific pair, which starting off with the Aussie dollar. So we call that Aussie dollar yesterday, we do have a bullish bias, hoping to inch up towards this resistance zone at 67.60/67.75. And given the fact that right now we start to see a clear persistence downward drift on the dollar against other major currency, which I shared with you all earlier at the start of today's daily dose, and also the hourly RSI seems to be getting rejected in the yesterday's session by this parallel descending channel, indicating that the upside momentum of this push up from the low of this Wednesday is losing its strength. So with that, there could be still a possibility of a slight drift up towards 67.60/67.75, given the fact that today could be a volatile session on the FX market with the impending respective key data that is out in the US session next, which is the non-farm payroll data. Later we'll touch more about that towards the end of our daily dose. So there could be still a bit of spike up towards this zone over here, which was yesterday resistance zone for our bullish bias. We do not want to tight our short-term pivotal resistance so tight at this 6775, 6760. We put it slightly higher to 6790. So as long as the spike up didn't surpass 6790, so what 6790 graphical zone over here, congestion zone, if you could see very clearly, being rejected on the 3rd of September before shaping that intraday significant slide. And if we do the Fibo retracement of this entire prior slide from 29th of August all the way to this Friday minor swing low, it corresponds to the 76.4% Fibonacci retracement as well. Okay, slightly above the golden ratio. So the golden ratio of 61.8% is the 67.75 level. All right. So because of the risk of a spike due to the impending volatile movement, potentially due to the release of the NFP data, we will use a slightly higher level. As long as the spike did a potential push up or spike didn't surpass 67.90, we will flip to a intraday bearish bias on the Aussie dollar. Near-term support level to watch on the intraday basis 67.10/66.85. A breakdown below 66.85, which is this Wednesday's minor swing low, exposes the next support level at 66.40, which is coming very close to the 200-day moving average as well. Right. Only an hourly close above 67.90, that means the spike up starts to surpass above 67.90, then it will invalidate today's intraday bearish bias on the Aussie dollar to kickstart a recovery scenario to retest last Thursday minor swing high at 68.20 and even 68.50 next. So that's for the Aussie dollar. Moving on will be the Japanese yen. So I could see the Japanese yen on the daily chart itself. It starts to be very bearish after the slight push up on the 20-day moving average. Then thereafter it plunges lower, and the hourly, pardon me, the daily RSI also starts to break down below a former ascending support level as well. Previously there was a bullish divergence, but this bullish divergence has been more or less invalidated or negated by the breakdown of this ascending trend line support that I drew over here. Okay, before we could see. Okay, so indicating that potentially there could be some form of further potential downside, but this is a daily chart, so we're talking about perhaps from a multi-day to multi-week perspective, there could be a revisit at this 140.25 level, which was the minor swing low of 28th of December last year. Okay, now, but on the intraday basis, what are the key levels to watch out for? So on the intraday basis, right, what we could see over here is that yesterday there was actually a rejection right exactly below the first resistance level at 144.43, this level over here. Okay, 144.43. So given the fact that since the price action has been rejected down below this level as well, and very clearly it broken down below this former minor ascending trend line support level that in dotted gray that I drew from 5th of August. All right, so I will use this level here as my Titan short-term pivotal resistance level for today. Okay, which is at 144.43. 43. Okay, so this one will be a normal resistance zone next to watch out. Okay, so using a Titan key short-term pivotal resistance level for today, pardon me, at 144.43, still maintain that short-term intraday bearish bias. First support level to watch out for will be 14160/40, which is the minor swing low area of 5th of August. All right, so only a breakdown below today may expose the 140.25, which is the medium-term swing low area of December last year. But however, if price action starts to break up above 144.43, then today's intraday bearish bias will be invalidated to see a messy choppy push up again back into this rangy configuration that the dollar yen seems to be forming last week. First resistance zone to watch out for will be at the 144.4540/90. Above these levels, revisit 147.50, which is very close to Tuesday and last Tuesday minor swing high area. All right, so that's for the dollar yen. Okay, so one more particular FX pair I'd like to share with you is pertaining to the FX cross market. So we know that we could take the dollar out. I want to share with you this particular FX cross market is pertaining to the Euro Swiss. So the Euro Swiss very clearly is trading in the downtrend, clearly below the 20-day moving average and the 50-day moving average, and so way below the 200-day moving average. And since the minor swing high of 20th of August, that means last week, it has been trading in a descending channel range configuration. And also what we could see right now over here is that the RSI momentum is getting weak as well after displaying a series of lower high over here, and it's now inching downwards below the 50 level mark. All right, so with that over here is that I'll be using the 20-day moving average as a key short-term pivotal resistance for today at 94.50 level on the Euro Swiss. So it seems to be exhibiting a short-term intraday bearish bias right now. First support level to watch will be the minor swing low of last Thursday at 93.50. A breakdown below it sees 93 figures/92.80, which is the lower boundary of this minor ascending channel, and previous minor swing low area of 5th of August and 6th of August. And if you do the Fibo extension of a potential fifth wave target, it corresponds to the 0.618 and 0.764 as well, the typical standardized fifth wave target on the downside. But however, if price action starts to break up above 94.50 level, the 20-day moving average acting as a resistance, then this intraday bearish bias on the Euro Swiss will be invalidated to potentially see a squeeze up to the next resistance at 95.20, a breakout above it potentially may revisit the minor swing high of 19th of August, acting as a next resistance at 0.9565. All right, let me put it in writing. Okay, so this is one particular FX cross pair that I'd like to share with you all for today, which is the 1 hour chart of the Euro Swiss cross pair. Now, with that, let us now take our attention or shift our attention to the other asset class, which is the major stock index or indices. Right, so the major stock indices over here is that Hang Seng or the Hong Kong stock market today, if you realize that it is not quoting at all, there's no trading on the Hong Kong market today. Because why? Because the Hong Kong exchange is closed in today's morning session due to a typhoon warning. Okay, so we will see later will this typhoon warning be removed in the afternoon session. But for now, because there's no price action that is quoting right now, no change in terms of the short-term levels. So we'll be still using yesterday's short-term pivotal resistance at 17,595 to maintain that intraday bearish bias, with the next support level coming in at 17,270/185. Same as previous day outlook. Only an hourly close above 17,595 will invalidate today's intraday bearish bias if the market managed to open in the afternoon session, or depending on the severity of the typhoon warning system. Only a breakout above 17,595 exposes the next near-term resistance at 17,925, followed by 18,070, potentially 18,000/160 next. Okay, so that's the key levels to watch out for on the Hong Kong 33 if the Hong Kong Stock Exchange lift the typhoon warning later in the afternoon session. All right, so now Japan 225, Nikkei 225 next. So Nikkei 225, yesterday we will have a bullish bias initially, looking for a minor push up or a rebound towards 37,570, 37,860. But if you look at to us that price action now is getting very lackluster after yesterday's rebound session. So yesterday's rebound session doesn't seem to be rather impulsive. It seems to be taking in the form of a bearish pennant formation. So what is a bearish pennant formation? It's something like a symmetrical triangle, but a small one. After this bearish pennant formation complete, it may resume its prior significant intraday down move. Okay, that was seen from the low of 3rd of September all the way down to 5th of September. And if you look at currently, the RSI also getting rather lackluster right now. And if you could draw the trend line support level right now, it seems to be attempting to break below this support level. Okay, there's a break below this support level at this juncture. So what we could see over here is that given the lack of upside momentum and the price action starts to form this bearish pennant yesterday, after yesterday's US session, we will be lack of confidence to maintain that potential bounce towards the 36,570/37, okay, 37,570, pardon me, 37,860 resistance zone. So with that, instead we will flip to a intraday bearish bias instead on the Nikkei 225 or the Japan 225, using a rather tight short-term pivotal resistance level, which was very close to yesterday's minor swing high that can't surpass at 37,170. So as long as 37,170 short-term pivotal resistance holds, we will flip to a short-term intraday bearish bias for today. First support level to watch 36,360. A breakdown below this level exposes 35,860 next, which is this congestion area here. Okay, from 7th of August to 14th of August. Only an hourly close back above 37,170 will invalidate today's bearish bias to reinstate that minor bounce scenario again, coming back into the picture for the Japan 225 for the next resistance zones to come in at 37,570/37,860 next, which confluence with the 200-day and the 20-day moving average, acting as a similar support, similar resistance zone as well, pardon me, on the Japan 225. So that's for the outlook for today on the Japan 225. Shifting our attention will be one of the major benchmark European stock index, which is the German 30 or the German DAX. So the German 30 and the German DAX also kind of lackluster. So very similar to the Japan 225 as well. It seems to be trading, yesterday price action seems to be trading in a bearish pennant as well. All right, so also failure to actually hit our resistance level at 18,820. So with that, given the formation of this bearish pennant, we will flip to a intraday bearish bias for today on the German 30. So as long as any bounce can't surpass above 18,820, because this is a very clear graphical resistance level, former minor swing low taken out and kickstart this dramatic intraday sell off previously. All right, so using 18,820 as my short-term pivotal resistance on the German 30, we will flip to a intraday bearish bias on the German 30 for today. First support level to watch out for will be this week low at this 18,474, which also correspond to the 20-day moving average. A breakdown below it exposes 18,350 next, which corresponds with the 50-day moving average. Okay, only a push up above 18,820 will invalidate today's bearish bias to kickstart the recovery scenario to revisit 19,025 resistance level next. So that's for the German 30. Now, shifting our attention will be the major US stock indices, starting with the Dow Jones Industrial Average or the US Wall Street 30. So no change. These two neutrality level actually holds. So prior on Wednesday, it came out, can't break above 41,200. Then there was a sell-off yesterday, tested the lower limit of the neutrality range at 40,610 and managed to survive as well. Okay, in the later part of the US session yesterday. So no change, still maintain that neutrality stance between these two key range level of 41,200 and 40,610 level on the US Wall Street 30, i.e. Dow Jones Industrial Average. So only either a clear breakout of these two levels, then we could validate our direction, a much more clear directional bias. That means an hourly close above 41,200, then potentially we may see the next resistance coming in at 41,535, followed by 41,800. And conversely, if a breakdown below 40,610, then we will see the extension of this minor corrective decline to revisit 40,140 next on the intraday basis, which correspond very closely to the rising 50-day moving average and pretty much close to the minor ascending channel support that I drew for 5th of August. Okay, so that's for the US Wall Street 30. Now, shifting our attention to the Nasdaq 100. So Nasdaq 100 yesterday tested exactly at our short-term pivotal resistance, come break out and shape that minor decline yesterday at 19,117. So for sure, 19,117 is a short-term pivotal resistance level that we got to respect. So using this level, we will still maintain a short-term intraday bearish bias on the Nasdaq 100 with a breakdown below 18,680. So only a clearance below 18,680 may see further potential decline on the intraday basis to revisit the next near-term support level at 18,320, which is the minor swing low area of 9th of August and 9th of August over here, and also correspond to the 200-day moving average, I think, as a support level as well. Only an hourly close above 19,117, a breakout above this 19,117 will invalidate our intraday bearish bias to kickstart a kind of a recovery scenario for Nasdaq 100. But first resistance to watch will be this stubborn range resistance that prevent any upside from reaching up higher since 28th of August, acting as a clear range graphical resistance at 19,630 next, right? Okay, so these are the key intraday levels to look out for on the Nasdaq 100. So now shifting our attention towards the commodities market over here, starting with Gold XAU/USD. So Gold XAU/USD yesterday managed to almost revisit the stubborn range resistance that is in place since the all-time high of 20th of August at 2,532. Okay, almost hit that level. So no change, still no change over here. I don't want to put it so tight. The short-term pivotal support level at 2,490, which is the 20-day moving average right now. So this could be a first support level to watch out for. But as long as any potential dip didn't surpass this very, very key short-term intraday pivotal support that we have since last week at 2,473, that has been tested 1 time, 2 times, 3 times, and held. So this will be a clear key short-term pivotal support that the bulls got to hold in order to maintain today's intraday bullish bias on Gold XAU/USD. A clearance above 2,532 increase the impulses or increase the odds of another impulsive up leg sequence to expose the next resistance zone at 2,588/2,595. Also correspond to this turquoise green ascending channel upper boundary. So what this channel, if you go to the daily time frame over here, this is the upper limit of this major ascending channel that I drew from 5th of October last year. 5th of October low last year. Okay, that means i.e. 5th October 2023 low. Okay, back to the hourly time frame again on Go XAU/USD. Only the push down and it start to break down below 2,473. That means i.e. the price came down with an hourly close below 2,473. That would invalidate today's intraday bullish bias to kickstart another leg of minor corrective decline to revisit 2,435/2,415, which is correspond to the rising 50-day moving average as well. Okay, so that's the intraday outlook for gold, still maintaining that intraday bullish bias. So lastly will be the West Texas crude oil. So West Texas crude oil, yesterday we are looking for that bounce, and that bounce almost hit that short-term resistance zone that we highlighted, which is also the pullback of this dotted line here. So this dotted line over here is actually on the daily chart, right, is the pullback of this former major symmetrical triangle range support now turns into a pullback resistance from the low of 20th of March 2023 that has been clearly taken down but on this week due to weak macro data out from China and some kind of lackluster data from US as well, okay, based on the ISM manufacturing data. Okay, so what we could see over here is that we was and also the RSI. So after that bullish divergence on the hourly RSI, this bullish divergence has been invalidated by the breakdown of the ascending trendline support yesterday. Okay, and it starts to inch lower. Okay, flashing a lower high over here. So with that, that means i.e. yesterday's upside momentum has been more or less been negated, and we will flip back to a bearish bias again for today using yesterday's high as my first resistance to watch, but the short-term pivotal resistance will be still the zone over here at 73.15, 72.24, which is the pullback line of that former major symmetrical triangle range support level. So as long as 72.24/73.15 short-term pivotal resistance not surpassed to the upside for today, we will still maintain that short-term, we will flip to a short-term intraday bearish bias. Pardon me. First support level to watch will be 68.20 next, which is the lower boundary of this minor ascending channel that I drew from the high of 18th of July. A breakdown below this level exposes the next support zone at 67.55/67 figure. Only an hourly close, a push up with an hourly close above 73.15 that will invalidate today's intraday bearish bias to see the continuation of that mean reversion rebound scenario extending towards the next resistance level at 75.07, which is correspond to the 20-day moving average acting as a resistance level as well. Okay, so that's the key levels and outlook to watch out for West Texas oil, and that also sum up our intraday technical outlook on the broad-based cross asset classes. So let's take a look at the calendar before we go. So like I mentioned earlier on, today's key data will be the non-farm payroll data. So what other data to look out for today in the European session before the release of the US non-farm payroll data over here? So what we could see over here is that there could be one data that impact the German DAX will be the balance of trade data out from Germany that is at 2 p.m. Singapore time, then followed by a ECB official Edison speech at 3 p.m. Singapore time, and we have a Eurozone growth rate again. So but this is for Q2, but this is a third estimate. It's not the first estimate, so that shouldn't be a big surprise for the market because there are two releases prior to this third estimate that will be released at 5 p.m. Singapore time. Then other than that, coming at 8:30 p.m. this is where the release of the US non-farm payroll data. So market will be paying very close attention to the absolute number, the number of jobs added. So this time around, market is rather having a bullish consensus or an upbeat consensus, more jobs added than the previous month of 160k from 100 more jobs added for the previous month. Market are calling for 160k jobs added for the month of August, above 114k jobs added in July. So any number that's less than 160k could disappoint the market, and also very clearly the unemployment rate as well that has slowly been ticking upwards. So market is looking for slight tick downwards of 1 basis point at 4.2% from 4.3% printed in the previous month of July. Okay, so that will be released at 8:30 p.m. Singapore time. Then other than that, we do have a Federal Reserve official speaking at 8:45 p.m. Singapore time, Fed Williams. All right, and another official, Fed Wheeler, will be speaking at 11 p.m. All right, and on Saturday, we do have another data. So China has been pretty strange. Has been releasing some key economic data on the weekend. So the balance of trade, that means including export and imports figure, will be released at 11 a.m. Singapore time on a Saturday. All right, so with that, that sum up today's daily dose of market insight. So I wish you all a great Friday, happy Friday, and a good and restful weekend ahead. And we shall speak again on next Monday. Okay, this is Kelvin here, signing off. Thank you.